Hello everyone. Today's micro lesson is going to be Hello everyone. Today's micro lesson is going to be on the difference between tax credits and tax deductions. The distinction is quite important for you to understand. Okay. First thing to remember is that a tax deduction reduces the taxable income. So the income that will be subject to tax, i.e. the tax base, reduces. Because the income is reduced, the tax will be reduced. But one of the fundamental issues that people have with a deduction is how much is a deduction worth? The face amount of the deduction is not the value of the deduction to a taxpayer. Put another way, in a little bit more comprehensible speak, is that deductions don't make something free. For example, if you were to have gross income of 1,100 and you were having a deduction of $600, and later in the course we will be looking at what gives rise to a deduction. Okay, so right now we're just dealing with nomenclature. So a $600 deduction, this leaves total income of $500. So we're going to assume a 25% tax rate. So $125 of tax will be paid, which leaves $375 in the taxpayer's pocket. Okay, we all see that? Yeah? Okay. So the value of the deduction is tied to the tax rate and the tax saved as a result. So here the $600 deduction was worth $150. There's two ways you can figure this out. One, you can take the $600 deduction and you can actually just apply the tax rate, so 25% of $600. Or you could just figure out how much tax they would have had if it wasn't for the deduction, and then you figure out how much they had in tax after the deduction and take the difference between the two. So in this case, without the deduction, the taxpayer would have paid $275 in tax. Since they only paid $125, the value of the $600 deduction was $150. So for clarification, the deduction is worth the amount of tax that it saves. Okay. A tax credit is a little bit of a different animal. It's treated as a prepayment of tax, or a payment of tax, if you will. So it reduces dollar for dollar the amount of tax liability. Remember, the tax deduction had a decrease in the amount of income. Well, a tax credit will have a decrease in the amount of tax liability. So the value of the tax credit, generally speaking, is the face value, but this will depend on whether or not you have a refundable or non-refundable tax credit. Those are the two types that are out there. If it's a refundable tax credit, it can actually generate a refund in excess of the tax liabilities a person may have. And if it's non-refundable, then you can get the amount of the credit up to the amount of tax you would have owed. And if there was additional tax credit remaining after that, then it just disappears. So to look at that, if you had gross income of $1,100, because apparently I like to use examples with 1,100, if we assume a 25% tax rate like we did in the previous example with the deduction, in this particular case, we would have $275 tax payable. If you have a tax credit of $200, you would only need to actually pay $75 because the tax credit is treated as a payment of tax of $200. Now, to get into the refundable versus non-refundable difference, use the same tax income and tax rates. If the tax credit was refundable, and say instead of a tax credit of $200, we used a tax credit of $500, then the taxpayer would receive a refund of $125. Why? Remember, they had $275 of tax payable, right? That was how much they owe off their income. But they were given a $500 tax credit. If it's refundable, then they can get a refund for the excess credit that they use. If it is a non-refundable, then, oops, I see a typo here. If the tax credit was non-refundable, that's what the second line under refundable versus non-refundable, and still $500, then the taxpayer would get the value of $275 of it. Remember that the $275 is their tax liability in this particular scenario. So if it's non-refundable, if they get a $500 credit, they only need 275 of it to take their tax liability to zero. What happens to the other amount of it, the other amount of the tax credit? It just disappears. They don't get to, generally, you don't get to carry over a tax credit. The remainder just generally disappears. So let's have a little bit of a thought experiment. I want you to think about this. Would you rather have a $200 tax deduction or a $200 tax credit? Remember, the value of the deduction is the tax that you save as a result, which is tied to the tax rate, or $200 of the tax credit. The tax credit value is generally its face value, assuming that it's fully refundable, or that you have tax liability in excess of your tax credit. So generally speaking, I prefer the tax credit. What scenario would your choice between a $200 tax credit and a $200 tax deduction? In what scenario would these choices be equal, i.e. the exact same amount? I want you to pause the video here for a second or two and think about that. Okay, so did you think about it? In what scenario would the choice between a $200 tax credit and a $200 tax deduction be equal? It would be equal if you had, there'd be two scenarios. One, that it was a non-refundable tax credit and it was worth only the same amount as the deduction tied to the tax rate. So let's say that it was a 50% tax rate. So the tax deduction would be worth $100 to you. Well, if you had a $100 tax liability, and it was non-refundable, then they'd be worth the same amount to you. So that's scenario one. Scenario two is if the tax rate was 100%. So a $200 tax deduction will be worth $200 if and only if we had a 100% tax rate, which would make it equal to a $200 tax credit. Again, assuming that you can fully use the tax credit. So anyway, I hope this was helpful. Thank you for tuning in.